Thank you everyone for joining us. We're going to be discussing cross-border and global taxation planning. My name is Nikki Jaiswal. I'm the Senior Director of APAC for LCR Capital Partners. LCR Capital is a private investment and advisory services firm that supports families interested in global opportunities. We focus on immigrant investor programs such as the USEB-5, Portugal Golden Visa, and citizenship by investment in Grenada. LCR also offers wealth management and advisory services that allow our clients to access private equity and venture funds, as well as U.S. mortgage and loan solutions. Our headquarters are in Westport, Connecticut, but we have offices around the world in Singapore, where I'm based, in Mumbai, Dubai, San Francisco, and Sao Paulo. We'll take a minute to introduce our key speaker, Ms. Jampriya Rabrai. She's the Managing Director and Head of U.S.-India Tax Desk at Asina Family Office. Jampriya is a seasoned professional and focuses her practice on cross-border tax planning, including mergers, acquisitions, trust, and succession planning. She caters to a variety of clientele, including global founders, mobile executives, mid-market enterprises, and high net worth individuals. I'll let Jampriya introduce Asina advisors.
Hi, Nikki, and I think thank you for the introduction. It's always a pleasure to work with LCR and, kind of get on a webinar and speak to, come out and talk to our prospective listeners in terms of engaging them in the conversation around US cross-border aspect, specifically with the idea in case they are looking to invest in cross-border investment or they're looking to move to the US. Asina Advisors is part of a broader and integrated multi-family office ecosystem called the Asina Family Office. As a whole, we provide a wide array of unique problem-solving perspective. Our companies provide specialized in-house deal support to private clients that are focused on post-transactional liquidity and holistic private wealth solutions that enable them to capture future upside while rebalancing risk for the next generation. Asina operates with global tax desks and provides services that don't just focus on tax, but for the client as a whole. We have specialized tax desk internationally, including in Australia, India, South Africa, UK, and the US.
Great, thank you very much. Before we get started with the discussion, I just want to take a few minutes to quickly discuss some housekeeping things. So first of all, we're recording today's webinar. We'll make the video available on our website after the session finishes. We're also planning to take questions throughout the session, and we've reserved some time at the end specifically for a Q&A. So please feel free to use the Q&A button throughout the session. We'll either answer those questions live, or as we go through, we'll answer them in the chat if needed. So please note that immigration by investment programs are based on investments, but the discussion today does not constitute an offer to sell or a solicitation to offer to buy any securities. If you're interested in alternative residency options, please reach out to LCR directly to discuss your particular situation in more detail. While we'll be discussing areas of tax and immigration law, none of the conversation or Q&A should be considered legal advice, please. Furthermore, we'd like to caution our listeners that every case is unique and that it's imperative that you consult with someone that has US experience in order to handle this. The topics that we'll be discussing are quite complex, so please reach out to us to address any questions and concerns you might have. All right, so with that, let's get started. So at LCR Capital, we're seeing a significant increase in inquiries from families looking to diversify their portfolio and their assets globally. Some view it simply as a lifestyle decision, while others are focused on portfolio diversification, risk reduction, and hedging. Jampriya, could you give a bit of information as to what investors should keep in mind when considering cross-border transactions of this manner?
Sure. See, a number of considerations are there, but I think what we can bifurcate into is the internal factors, which are personal to an investor, and external factors, which are out of the recourse of an investor to look into. Internal factors include the investor's country of residence, where the investor is looking for an opportunity to invest. What is the mode of investment, whether it's direct or through an entity structure, and what is the risk appetite for an investor? What is the period for which the investment is to be made, whether short-term, long-term, the form of investment or the constitution of the investment, the purpose, whether it's for an active business trading or active business profits or for passive income. whether it's for the course of alternate residency, with the ease of travel, safety aspects, and whether it is for protection of family wealth or generation of new wealth, addressing any uncertainty around it, what is the exit strategy? In terms of the external factors that we look into, we can see political or economic relationship between the countries, legal and regulatory framework, and specifically when it comes to India, and tax treaty framework, domestic tax laws in the countries. So primarily, those are the things that kind of overview an investor's decision in terms of making a cross-border investment. And maybe I think when I said discussed about tax aspect, I can give you a few examples. Like we've seen, even with your clients, we've seen that a lot of investors are interested in either investing in startups or they're interested in investing in real estate. So if an investor is really keen in being, migrating from India to the US for long term and wants to invest part of his investment in startup, there could be certain exemptions which he or she can avail at the time of exit. So those are the purviews need to be kept in mind, like qualified QSBS exemption, which is available, whereby at the time of the gains realized from the QSBS stocks or shares, you can get an investor could get an exemption of around $10 million. So that can kind of help a person to strategize as to what could be the prospective tax exemptions or deductions that might be available. Similarly, for making an investment in real estate, whether it is feasible to today make a direct investment in real estate, or it is feasible through going through an entity structure. The difference outlines in the way a person wants to, whether a person wants to protect an asset, or if a person wants to just get any deductions that can help in reducing the income on an annual basis, whether a person is interested in making personal tax filings in that country or not, or wants to go through an entity, which is much more easier, whether that person wants to form a real estate trust in order to set it up so that the exit strategy is much more easier. So all are these perspectives that we need to keep in mind. Even in case of general assets that a person can hold, there are conditions attached to it. Like, for example, in case of, there's something under the US tax provision which offers like-kind exchange, which defers the tax instead of being taxed today on a sale of asset. If you're reinvesting in a like-kind asset, you could defer the gains until and unless you sell the final asset. So there are certain specific provisions which are available even in case of cross-border investments. Yes, some specifically available to US residents. For example, we discussed about the QSBS exemption. It is specifically available to a US resident, but there are others like kind of exchange, which is available to everyone, be it individuals, C Corps, S Corps, trust, or any other taxable person. So I think the strategy or the factors that an investor needs to keep in mind, in addition to the other factors, is about what is the main purpose of doing it, what is the strategy around it. And in keeping all this in mind, I think for an Indian investor primarily needs to think about the mode of investment, because there are restrictions under the LRS or the ODI scheme. If a person is making a direct investment under the LRS, there's a limit of annual financial year limit of $250,000. And in order to manage that, within that amount, keeping in criteria as to the purpose of the investment, how he or she can spread it, kind of makes a lot of big deal around it. And what is the specific purpose for it is allowed. For example, if it's an Indian company which is investing, just making a cross-border investment in a financial company outside India, there are certain add-on conditions which need to be fulfilled before a company can even invest in the financial sector outside India. So those are comprehensively aspects which we need to look into it. And I think an advisor can kind of really help a client in terms of ensuring all these compliances are met, so that there is not only a compliance around the fact that when you are making the investment, there is also an informed investment at the time of exiting the system. So that there's a comprehensive solution to it. Obviously, there are certain factors that can change over time because tax laws and other aspects can kind of update over period. But these can overall help in kind of making a decision as to what would be the right way to go about it.
Perfect. Thank you very much for that overview. So getting a bit into the tax implications, reporting requirements, what do you see or what needs to be taken into consideration when investing offshore from a two-pronged approach, one from the country where the investment is made, and then as well for our Indian investors from an India perspective itself, what needs to be taken into consideration?
Sure. And I think to start with answering that question, what we have seen in terms of the change in the way investors are now approaching the offshore investment is that they're more pragmatic. They understand what their objective is in terms of investing. It's just that when they're discussing with the advisor, it needs to be more eloquently put out so that the advisor is more informed and can mitigate tax implications on the cross-border aspect. There's nothing as there's generally not an idea now that investors are more inclined to having a zero tax structure. It's more what is a tax efficient tax structure that ensures there is a return on investment, in addition to making sure the tax costs are complied, annual compliance costs are met in both in the country in which they are a resident and the country in which they are making an investment. When you said about from the perspective of India, I think if a person is a resident of India, primarily the regulatory requirements need to be met in terms of, as we were discussing, whether it is under LRS or the ODI, the limits need to be met. Any approvals that are required need to be complied with. Annual compliance with either RBI under the tax provisions should be done by an individual with regards to foreign investments. And if there is any change, that needs to be informed. The domestic compliance implications with regards to the how to disclose an investment, whether how to disclose income and gains on that investment should be annually complied, in addition to taking in note the tax treaty framework within that perspective. In the country where the investment is made, obviously the first aspect to be looked into is what are the tax costs, because that would add on to the entire return that the person would be getting on an investment. In addition to that, what are the compliance costs? Are there any exemptions or conditions that need to be complied with on an annual basis in order to assure that a person is compliant in both the country of residence and the country of investment? And even it is more so important because even if a person is looking for alternate residency provisions in future, tax compliance is one of the things that the immigration authorities also look into. And with the way that the transparency is coming around in tax framework, in addition to the banking framework, I think it makes more sense to be much more apprised what are the disclosure requirements and kind of go about it in a very clean and a transparent manner.
Makes sense. With all that you've just mentioned in terms of taxes, what is there really a way for investors to structure offshore investments in a tax efficient manner, and how can they go about that?
What is important for families or private clients in order to invest is to be able to organize and have the flexibility around reorganizing their structures in a way that it is more, there is return on the income and there is protection of the wealth in case they want to pass it to the next generation or ensure there is that wealth that they are creating is kind of ensured in a way that it grows from there. And I think the instability that we have seen in the last few years, people are still recovering from it. But at the same time, with advisors on their side, I think what everyone has tried to ensure that the investment is protected and it is kind of ensured that, with the idea of expanding in different jurisdictions, it is kind of it is in a more relaxed way that it is taken ahead rather than a hurried decision around is taken into consideration. And I think at this stage where a person has to begin in order to contemplate the idea of investing in another jurisdiction, they should be prepared to talk with an advisor to look into the situation and advise on the considerations that are relevant for your specific needs. And it is to be customized. And that's the reason I think when you were speaking about the disclaimer, a client or an investor deserves the specific situation that he or she is in terms of the specific advice around it. And there are different ways to ensure that it could be achieved.
Great, thank you. So I want to pivot a little bit and talk a little bit more about alternative residency options and the investments that we're seeing in that space. Over the last few years, there's been a heightened interest in alternative investments. Beyond financial assets, we're seeing that families are now also considering their health, their legacy planning, quality of life, when they're using that as key contributors to what they refer to as their holistic wealth. So in search of better healthcare options, open and flexible business environments, access to education, professional opportunities, we're seeing that many investors are now starting to actively explore avenues for alternative residency or citizenship programs. These programs can offer, a safety valve for managing uncertainties, and we've definitely seen that rise over the last couple of years with COVID and just the instability that people have faced being locked into countries and the uncertainty of what was going to happen. But obviously these investments require a lot of advanced planning. They often have a lot of significant tax implications as well for the investor. So it would be good for our audience to really understand, does getting residency or citizenship in another country automatically make you a tax resident there?
When you say residency, from US perspective, maybe I think that would be an example that we can take. Under US laws, residency is established if either a person is a US citizen or a green card holder, or applies to the minimum number of days test, or elects to be a resident in that country. So, and there is a difference between holding a citizenship and residency as well. So, and when we see the implications with regards to a US person who is a US resident versus a non-US person, the taxability is different. A US citizen or a green card holder, or once a person becomes a US citizen or a green card holder, then that person is liable to tax on a worldwide basis, irrespective of the fact that person whether stays in US or stays outside US. In case of a person who complies with the minimum number of days test in the US or elects to be taxed as a US resident in the US, that person, till the time he complies with that test, that person would be a US resident. After that person moves out of the US, then he or she may not be liable to US taxation, depending on the circumstance the person is. And within that framework, if we see that when you say automatically, there wouldn't be an automatic, but I think on complying with any of the conditions under the residency test, a person can therefore become a resident. But there are provisions under the tax treaty framework between countries, like USA has tax treaty framework with India, wherein if a person is a resident of two countries, there's a tiebreaker test which needs to be applied in order to determine what is the country of his primary residence. And under that framework, accordingly, the taxation could be determined. So there is a framework around which the tax residency could be determined. And there's a framework around where would be the primary residency and how the taxation implications would be based on that. And we have seen, I think during COVID, there were people who were kind of, due to lockdowns restrictions, they were restricted to travel. And as a result of that, a lot of people kind of overstayed the limit in the countries in which they were required to. And as a result of that, the authorities came out with provisions to say that, if there is, say, 2 months overstay in a country, then you don't qualify as a resident of that country, even if you comply with with the minimum number of day test. And as a result of that, those people were not required to comply with the US tax as a resident of that country.
I guess looking a bit more in terms of the actual investments that someone would make for alternative residencies, particularly for India, I think there's some additional considerations as to just, being able to transfer money into another jurisdiction for these residency and citizenship options. So could you just briefly touch on what an Indian investor would need to sort of keep in mind when they are looking at these options?
Sure. See, when we discussed earlier as well about the LRS or the ODI scheme, these are specifically the frameworks legal frameworks which are set out by India in terms of ensuring that the Indian residents or people from outside who are coming to India, they invest within the policy framework that they have set out. And this administrative framework lists certain conditions in order to qualify, or sometimes have thresholds beyond which if you cannot invest, or if someone has to invest, there has to be a genuine reason of investing that. And RBI, after it considers the application, would be able to allow or kind of grant a waiver in order to make an investment beyond a specific amount. In relation to the liberalized remittance scheme, or known as LRS, all resident individuals are covered under it, and it includes minors as well. And they are allowed to freely remit around $250,000 in a financial year. And a financial year in India starts from April to March of the following year. And the transactions that are generally covered are permissible current account, which are the regular transactions, capital transactions, or a combination of both these transactions. As I said, there are certain prohibited items under the scheme, but there are considerations like in case someone wants to go for a private visit to country outside India, want to make donations, is going abroad for employment or immigration or maintenance of close relative outside India, meeting expenses, medical expenses, or paying any expenses in connection with the medical treatment. All these are not covered under the current account transaction, and then therefore they are freely allowed to be current account transactions under the FEMA provisions. If you see on the hindsight as well, on the US side, when a person is gifting for all these provisions to a person who is a US resident, in this regard, US doesn't even tax those under the gift tax provisions. So the authorities do understand that there are certain provisions which should not be covered, considering the emergency around it or the way they need to be organized. And in order to kind of structure these aspects, we generally have sometimes tell our clients that in case you're sending money for education purpose, it is better for you to directly send it out from your India account to the education institution, so that A, it is not covered under the US gift tax provisions. B, it is not even covered under the LRS scheme on the India side. That way, you're simply able to organize and kind of clearly lay out the reason of investment or sending out the purpose of sending out the funds outside India. In that way, it kind of helped to organize the clients' personal decisions versus the expenses that they are required to meet in order to cover any kind of expense which is under the permissible limits outside India. The other aspect that we were discussing was the overseas direct investment, or the ODI, which generally an investment which is in the form of contribution to the capital or the subscription to the company outside India. Generally, it is a structured framework which is opted for by Indian entities or companies that are either looking to set up subsidiaries or expanding family business outside India. Within the ODI, I think the restrictions are primarily around the sector in which you are investing. If it's a finance sector, there are conditions attached to it in terms of meeting the net worth, profitability in the last few years, in order to be eligible to invest outside India.
Great. So before we move away from some of these aspects that are very particular for Indian investors, I just want to also get your thoughts on banking considerations for any Indians that are considering moving outside of India or that have already relocated out of India. The types of accounts that they should consider if there are children studying in the US. What is the best way for a family to be able to gift funds overseas, and what types of considerations they should look at?
There's certain things in India which are not, I would say, there's certain things that we should do before a person moves outside India for a longer duration. If a person is thinking that, it's probability that I would be outside India for a long-term duration, they should go to their bank and inform that, hey, I would be a non-resident going forward because I'm expecting to be staying outside India for a longer time. The bank would then, on the request of the client, would convert the account from a regular savings account and do something called as non-resident ordinary account, which is the NRO account. And the NRO account is generally to manage their incomes or deposits which are earned in India. So if a person is, say, as an Indian resident, already has investments in India, any income on those investments could directly be deposited or could directly be transferred to that NRO account. The other form of account that Indians can create, non-residents can create in India is the NRE account, or it is also called a non-resident external account. So if after moving to outside India, if a person wants to send some money to in India, then they can transfer that money to the NRE account. The difference between both these accounts is that the NRE account generally considers external investment which has come outside India, or transfer of funds which is outside, which has come from outside India by a non-resident. They generally don't charge any taxes or are not concerned with any tax compliance on that, because the banks in India generally assume that you've already paid tax before transferring those funds in NRE account. In relation to NRO account, if you earn any income on that NRO account while the funds are sitting in that account, in the form of interest, the banks generally would charge a TDS at the rate of 30% annually. And the reason they would do that is because they understand you're a non-resident, and in order to ensure that tax authorities have their fair share in terms of the deposits in the account, they generally charge that as a tax at source. A non-resident can file a tax return. I know it's an additional compliance cost, but a non-resident can file a tax return, claim a refund if he or she is below the limit, or file a tax return to adjust the actual tax due on that income. And that is an additional compliance cost, but at the same time, this is the provision to go around with different bank accounts that they have.
Great, thank you. So we spoke a little bit about when you become a tax resident, particularly for the US. I'd like to delve a little bit deeper in the US in particular, and just have our audience understand a bit more about taxation for US. When does an investor become liable to file and actually pay taxes in the US?
So as I mentioned earlier, for a US person or a US resident, is liable to file taxes in the US on a worldwide basis. So even that person is not in the US or is a resident of another country, still that person would be liable to file or pay taxes in the US. Obviously, there is a tax treaty framework. Even under the domestic tax provision of the US, you can claim a credit for any taxes that you have paid outside US. So that allows a US tax person to be compliant on the US side. For a non-US taxpayer, the compliance or the filing provision only applies if there is any US sourced income. And when I say US sourced income, if there is an active business profit earning that a person is making from US business, then that person might be required to file taxes in that country. And when we are talking about US residents, I think it is important to kind of, with the clients that you assist with, in case of green card holders, I think it's important that what would be the date on which their residency would specifically start under the tax framework. Because it's different when we discuss about the regulatory framework and the tax framework. Under the US tax framework, for green card holders, if they do not have a prior history of being in the US, the first day on which they enter US as a green card holder, that would be the day on which their US residency would start. And that is key, because if they have any prior income, they can kind of segregate between the day they become a US resident versus the day period prior to that date. And accordingly, the compliance need to be considered. An additional compliance for US residents also come in relation to reporting under the FATCA provisions or under the reporting of foreign bank accounts, or and it is an integral part, because often we have seen that when clients come to us who are US residents, they are concerned about the fact that the tax compliance should be done. In addition to tax compliances, these are additional aspects which need to be looked into. And I think generally the accountants are aware in terms of these compliances, but if an accountant is not aware about it, this can add to penalty or perjury issues in future. So in order to ensure these aspects in mind, I think this is the reason to make clients aware that what are the additional compliances they need to be aware about.
Great. So for citizens or green card holders that are not permanently residing in the US. Can you just explain a little bit more about this? A lot of our client base, they look at investing for a green card. They may not want to move to the US as soon as they have their green card. So, one, in terms of what is considered residing in the US and how that impacts their taxes, but also, what deductions can they look into on their tax filings if they are not actually residing in the US at the time of filing?
Sure. As I mentioned, US is one of the two countries in the world which applies global taxation to its citizens and residents, long-term residents or green card holders, even if they are not in the US. And this date back to, I think, the First World War. I think it was, and we don't expect it to go out anywhere. So I think, and I think at this point, it is very important to for our listeners to be mindful that there is no reason to be kind of afraid of the compliances. I think it's important that once you're in the compliance framework and it is done in a right way, that it gives you much more ease in organizing yourself and your financial particulars in specific. And whenever we discuss the aspects around compliance and ensuring that there is tax provisions are specifically met, I think this is one of the concerns that we have seen where clients are a little apprehensive as to what additional compliances do we need to do. And as a global taxpayer, I think as we discussed, paying taxes, there are credits in the form of taxes that have been paid in another country. And in relation, if there is any self-employment or if a person is stationed outside the US, who's a US citizen or a resident and earning any salary income, there is something called as foreign earned income exclusion, which is a form of an exclusion for the income on which you're already paying taxes in that country in which you're a resident after moving outside in US. And currently the limit is around 112,000 for a single filer in the US, but it kind of changes and updates on a yearly basis. But those kind of exemptions can allow US taxpayers to plan their tax implications. And sometimes we sit with clients to help them understand if they're moving outside India or if they outside US, or if they're contemplating to move, retain the US citizenship and then find an alternative residency option as well after that. In that case, what we do a comparative analysis of the tax implication or the tax cost that they would have at the end of the day. And in doing that, I think often we have found that in their countries, like if someone is from Australia and someone is working in Australia, moved to Australia and a US citizen, then because of the higher tax rates in Australia, there are no additional taxes on the US side. But there might be certain leakages that we need to address too, and because of which there might be additional US taxes that might be due. Similarly, for a person who is from India, who is working in India, but is a US citizen, for that person, it might be imperative to see what is the rate of taxation between the countries to tax certain items. For example, long-term capital gains. In US, there's a progressive tax which is at the highest rate of 20%. Similarly, on India side as well, there's 20% in relation to long-term capital gains of certain assets. So in order to do a comparative analysis to let them understand as to what would be the additional tax or cost in order to ensure that there are no tax leakages in which they want to organize, or if there are any leakages, how to go about those leakages so that they're more aware as to managing those costs against the returns. So those are the items that we kind of help them or work with them in order to ensure when they're taxed on a global basis, they are compliant. And at the end of the day, they're more aware of the tax costs which can incur as a result of changing a residency.
Great. Can you discuss a bit what you see as sort of best practices for estate planning in the US, inheritances as well?
Sure. When we start with estate and gift tax, I think they're generally taught in the same parlance. The first aspect that needs to be looked into that the residency considerations for under the US Income Tax Act does not primarily or prima facie apply in case of gift and estate tax. There's a separate residency definition for gift and estate tax purposes. And in addition to being a US citizen or a green card holder, that person is required to meet a domicile test in the US. And to put it simply, domicile basically means that you really have a long intent of being in the US or continue to have a connection with the US. There's certain factual tests that we need to go around in order to determine if a person is a domiciliary of US or not. But on a broader scale, that is what it means in terms of a domicile test. And the US imposes gift and estate tax on US persons, as I said, both citizens, green card holders, on their worldwide assets, and regardless of where they live. But in case of non-US citizens, what it limits is only with regards to the US citus assets. So if I find someone who is investing in the US, just say I want to buy a real estate property. I bought a property there. I'm not a US citizen or a resident. If at the time, at my demise, the estate tax provisions would only cover the US citus assets. And currently, India doesn't have any estate on inheritance tax, nor in between US and India, there is any estate or gift tax treaty. So this is an additional form of tax that a person has to kind of be sure that it would be applicable in case there's an exposure on the US gift and estate tax. There are certain exclusions, like if a person is a US citizen or a US resident, green card holder or domiciliary, there's an annual exclusion of currently 12.06 million for US citizens and residents. For non-US citizens, it is currently at $60,000, which is in a form of a lifetime exclusion, which is allowed. And for estate and gift inheritance tax purpose, it may be imposed even at state level, because in the US, there is a federal level of taxation, and in addition to that, there is a state level of taxation. In certain states, it is estate taxes levied in the form of estate or inheritance tax. So it depends upon state in which a person would be a resident or where the property might be located in order for estate and gift tax provisions to apply in that state. In addition to that, I think we can also consider about any transfers or gifts that are made to the trust prior to person becoming a US resident. And that framework, while we are discussing structures or while we are discussing with our clients in terms of how to structure their pre-immigration aspect in the US, that is one of the aspects for people who already have trust structures in place to be discussed about. That there would be possible implications if they're contributing anything in the trust prior to moving to the US as well. And there's a lifetime gift and estate tax exemption, as we discussed, at a 12.06 million. And unless the tax law changes, there's a sunset clause where it is expected by the end of 2025, it will reduce to 6.2 million as of now. And I think talking specifically about gifts, as we discussed earlier as well, there are certain gifts which are, if made to a person with regards to education, school tuition, charitable donations, medical expenses, or in the form of gifts to spouses or dependents, those are not covered under the gift tax provisions under the US laws. So in addition to not making any reporting tax compliance, there is no required as regards to the remote reporting compliance on that as well. And like the estate tax provision, there's an annual exclusion also for the gifts that are made or received during a year. In case, as of now in 2022 calendar year, it is at 16,000 for a single filer. And if there is a married couple, it's around 32,000 a year. And I think the rates in terms of gift and estate tax is at the federal level do range from 18% to 40% as of now. And if a person makes a gift if a person receives a gift from a non-US resident beyond the exclusion requirement, then reporting compliance needs to be made on an annual basis in the year in which the person receives a gift. You can also apply a US resident can also apply in addition to the annual exclusion limit, the lifetime exemption in order to not comply under it, but reporting compliance should be made on an annual basis.
Can we touch a little bit on the exit tax for the US in case somebody wants to renounce a green card or citizenship?
Sure. In discussing exit tax, I think it is imperative from the perspective of people who are thinking to immigrate to the US. It is important for them I would say within the first 7 years, it is important for them to understand if they want to be in the US for a long term or not. And at the time, if in the 7th year, they're thinking about either exiting the US tax system or they're thinking of, continuing with the long-term residency, I think what is imperative for them to understand is that if in future they want to exit the US tax system, would they be covered under the exit tax provisions or not? To be covered under the exit tax provision, a US resident or a citizen should be a long-term resident, either a citizen or a long-term resident for at least 8 years out of the 15 years block period. And there are additional conditions after which are attached to it, like there should be a minimum net worth of 2 million. A person should have been compliant for at least 5 years prior to leaving the US. He or she should have paid the taxes in the US. There shouldn't be an open assessment or an audit case in order to, during the time that person is making an exit tax application. This is part of the, when we are submitting the reports to the immigration authority, this is part of the application process where there needs to be a declaration that you're a tax compliant, you were a US tax compliant person. And in order to ensure that, I said at the end, in the 7th year, more so because of the limit for long-term residents who are green card holders and who have been a green card holder for a continuous period of 8 years. So at the end of the 7th year, I think before the end of the 7th year, it is imperative that if a green card holder wants to exit the US tax system, he or she should start planning in that 7th year. Rest about the fact that what is the value of the net worth of that individual as well.
Great, thank you very much. So I'll pause here because I want to be mindful of time. We've got about 15 minutes left for this session, so we want to open it up for some Q&A. So if you guys haven't already sent your questions, please do so. We can start with a few questions that have come through. So can you just talk about some of the common mistakes or issues that you've seen investors having that could be avoided by proper pre-investment planning?
When we say mistakes, I think it's just about the fact, as I said earlier, investors are now much more aware about what they need to discuss with the advisor. But I think one thing that investors should be very mindful of when they're discussing with their advisors is to ensure that whatever they shouldn't look out for a zero tax structure or for which there could be a simple way to organize it. Sometimes there are investors who come and say that, I want offshore trust which can invest in the US so that I don't have to pay any tax. The fact that the compliance or the cost in administrating that trust would be much more in comparison to the cost of making a simple investment. I think that is what investors need to be mindful of, because every investor has its own specific facts, which needs to be analyzed in the light of the due diligence that they deserve. So I think it's more from the fact that when they're reaching out to an advisor, they should explain what their factual situation is, and B, have a room around discussions around what could be the possible options for them, and do a comparative analysis to make a mindful decision.
Great. It's very imperative going forward for our investors to take a look at. Another question we received is, can you re-domicile a foreign state?
When we said about domiciliary assessment, it is actually a factual assessment, and it is at the time when a person estate implications need to be determined. And if a person is, say, a US citizen, then or a long-term green card holder, and has connections, economic and personal ties within the US, that kind of in a short frame, I think site can really establish a person's connection or domicile in the US, even if a person is not staying in the US. But the imperative analysis around domicile is generally on a factual basis, and we need to consider all those aspects when determining whether a person has a potential to fall under the estate tax provision on the US side.
Great. Another question. Who can claim the benefits of a tax treaty and how do you go about that?
So first, there has to be a tax treaty between countries in order to claim a benefit. For example, US has a tax treaty with India, and there's an agreement around certain aspects as to how or which country would be taxing. But if you see, US doesn't have the tax treaty arrangement with Singapore. So generally, any withholdings on the income that is repatriated to Singapore, it is generally at a higher rate. It could be arranged in a way, it could be structured in a way to see how the tax costs could be mitigated. But at the same time, the taxation would be under the domestic laws of those countries.
Okay. Could you talk a little bit about the types of income that would fall under the double taxation agreement between India and the US? What would be potentially double tax and what would not have the double tax because of the treaty?
The idea around having a double tax treaty is that a taxpayer is not taxed twice on the same income. And the income, generally there are articles. It is a tax treaty is a form of convention which is divided in the form of articles under which it covers. It discusses around residency, discusses different forms of income. When I say different types of income, it includes your simple dividend income, interest income, royalty, any consulting fees, director fees, any permanent profits earned by a permanent establishment in one country of another of a company, then anything related to capital gains, income from real property. All these aspects are generally discussed within the tax treaty framework. There is generally a clause around the income which is not covered under the tax treaty specifically, the manner in which could be taxed. And for instance, if you see the capital gains provisions under the US-India tax treaty framework, it specifically clearly says in relation to capital gains aspect, it'll be taxed. It gives an exclusive right for the countries, India and US, to tax it under the respective laws of the countries. But at the same time, the tax treaty, in addition to tax treaty, the domestic laws of the country, it allows the tax credit mechanism around it. So if you're paying, say, and in relation to real property, generally the country where the real property is located happens to be the country having the primary residency right. So say, for instance, if there's a US citizen who has a property in India, and he sold off that property in India. And as a result of selling the property, India would have a clear right to tax it even under the tax treaty framework. After that person has paid taxes in India, that person, while filing the US tax return, would claim that, once computing the taxes on the US side, would claim a credit for the taxes that are already been paid in India. There could be additional tax depending upon whether the nature of the gains is short-term or long-term, because if it is a short-term capital gain and a person falls under a higher tax bracket on the US side, there might be additional taxes, which might be due on the US side.
We have a question here of, we focused a lot today on the US, but what other jurisdictions can Asina help with in terms of planning and taxes?
We at Asina generally primarily work on the US side, but we have, as I mentioned earlier, we have tax desks in Australia, in India, in South Africa, UK, even some countries in Europe. So I think depending on the client and the exposure in regards to whether it's the residency or with regards to an investment, we kind of network with reach out within our network in order to kind of ensure that a wholesome solution is available for a client.
Great, that's very helpful. Thank you. All right, let's see what else we have. If you guys haven't submitted questions, please continue to do so. Let's see. There's a question about gifting between Indian residents in foreign currencies overseas. Is this allowed? What are tax implications that the Indian resident would face for this?
See, if a person wants to gift between Indian residents, it's if it's just within India, then and if it is between the relatives, then it is not taxable under the Indian provisions. If it is if a person is making, if an Indian resident is making a gift to to another Indian resident's foreign account, I think there are banking regulations around it as to, because when a person has to send a wire outside India, there's a reason that needs to be demarcated on that wire, and the taxation effect would always be determined by the domestic provisions or the domestic tax law provisions. If it is one resident to another, it is generally not. It is tax neutral. Just to add to a relative, I mean to say, or the exemptions covered under it, not to everyone.
It's a good distinction to make. Okay. So inheritance gift taxes, I think you touched on this a bit earlier, but can you just explain a bit again about if these are applicable in the US and what those limits are?
Sure. As I said, primarily residency is one distinguishing factor from what we discussed about the implications for for a person being a resident under the US income tax laws. And for gift tax provision, there's an additional requirement to be domiciled in the US in order to be compliant under the US gift and estate tax provisions. For a US resident, primarily a person is taxable on a worldwide basis. For a non-US resident, the gift and estate tax provisions applies only with regards to US citus assets. And the annual exclusion in terms of gifts is currently at 16,000. And for estate and gift tax purposes, it is at 12.06 million, which with a sunset clause of 6.2 million by the end of 2025.
Great, thank you. Okay. Can you just touch a little bit about, when you would advise an investor to approach, a CNA family office or tax specialist when, at what stage should they really begin this discussion?
I think that's a very relevant question, more from the perspective that people who are looking to immigrate specifically to the US, they should know, they should be aware. I think more so than being afraid of what comes ahead, I think it's more about being aware as to what are the aspects to be looked into in order to ensure that the immigration is in alliance with what they are looking for in that country. If it's a long-term decision to move to in that country, I think it is imperative that they need to kind of jot down as to what their current assets are and what possible implications or what are the different tax aspects to be looked into in order to ensure if they want to retain those assets for a long term, that they need to look into. The decision around whether they need to hold the asset, sell the asset prior to moving out of the US, out of India. I think it is imperative that whenever you are taking a decision to go ahead with your application for getting into either an EB-5 program, it's imperative to talk at the same time with a tax consultant or an advisor to understand what could be the possible implications around it. And once you have a decision around it, I think it is, as an informed investor, you're much more clear as to what decision you want to take ahead.
Yeah. We have one other question here that's just come through. What are the tax implications for UAE residents who are Indian citizens?
I think of late we have seen a lot of UAE-based residents who are or Indian citizens who are still retaining Indian citizenship, who are making investments in the US, and it is more favorable because of the tax framework in which currently UAE is organized with, and it gives the flexibility to the investors who are not looking to move to the US, but at the same time just reside and retain their UAE residency or the Dubai residency and continue to invest on the US side. obviously there are factors to be looked into with regards to specific case of each investor, the manner in which they are structuring their investment, whether it's a passive or an active investment, to be looked into in order to kind of conform to what could be the tax implications.
Great, thank you. Okay, so I think we've gone through all the Q&A questions that have come through. If anybody has any last minute questions, please feel free to drop them in the chat or the Q&A function. Just if you have any closing remarks that you want to make, or anything else that we may not have touched upon, if you'd like our audience to know about.
Sure. I think as a closing remark, I would always say that we see now that the investors are more pragmatic in their approach towards reaching out to their advisors. And I think in this unique approach that they are now following, it is more imperative that we as professionals, we make them aware about the possible compliance or possible assistance around how we can educate them. But at the same time, I think it's important for investors to be much more mindful of the fact that whatever they are, the reason which they are investing, are they able to achieve that or not? Whether it is residency, whether it is long-term investment aspect, or whether it is just a simple, idea of investing in a different jurisdiction. So I think it's important to be clear about the purpose for which the investor wants to invest, and ensure that the tax structures or the tax provisions are aligned in order to meet them. There is tax compliance. There's the policy framework is aligned to their idea of investment as well.
Great. Well, thank you very much, Jampriya, for your time today. It was a great discussion, a lot of insight. There's a lot of information. So again, I would urge our audience that has any questions to reach out to Asina or to LCR so that you can get more specific information from your case. So thank you guys all for joining us, and please feel free to reach out, and we hope to speak to you all soon. Take care.